Jim Grant, 2020 predictions and how he sees monetary policy playing out in the year to come. This is from a recent Real Vision video, and I'm going to explain his views in 7 simple, fast steps. Step number 1, his predictions for 2020. More state coercion and gravity. To hear Jim articulate this in his own words, as we know only he can, let's go to the transcript of the video. So the first question is, what are the 2 things to watch in 2020? And Jim sums up my political views very well right here. He says, I am all for live and let live and for individual action as opposed to state coercion. What I see on the horizon is a very good chance of stepped up government action in all realms of our lives. He goes on to talk about gravity, and of course he's talking about gravity in the relationship to asset prices. As to gravity, who knows? It may yet work its will on our financial assets, not a few of which seem to be defying that law of gravity. So what Jim is pointing out is something that a lot of us recognize. Stocks are in an all-time high. Bonds are in an all-time high. Corporate debt is at an all-time high. Real estate is at an all-time high. In other words, we are in a Fed-induced everything bubble, and Jim believes that sooner or later, gravity will take charge. The Fed is not stronger than the laws of physics. And one thing I want to point out for all of you whose family members and friends think that you're always wearing a tinfoil hat, you've got some good company. Stan Druckenmiller, Jeff Gundlach, Ray Dalio, Warren Buffett, although he won't admit it, and now Jim Grant. The only people that really disagree with you and have brainwashed all your friends and family are academics and the mainstream media. So the question comes, would you rather be on the side of people who only know this from a theoretical standpoint or actual practitioners? Step number 2, examples of where gravity might just take over in 2020. WeWork and Uber. Back to Jim Grant's interview. He says, along comes Uber with a promise of revolutionizing the taxi business through what? Through networking, through scale, through gobbledygook, through concepts, and they are waving as a thing and raised what? $10 billion as a startup. And they proceed to do what? To lose money hand over fist. The bigger they get, the more they lose. It would seem to suggest as if there is no money in the concept. The concept persists, company goes public, I think in part or in great part because of interest rates being where they are, and the margin and the opportunity cost of investing in something else being very low. That's Uber. Jim makes a fantastic point here that companies like WeWork and Uber wouldn't exist. They would have never been funded if it wasn't for the Fed keeping interest rates artificially low. And at the end of the day, the average people, just like you, end up holding the bag. Let me explain how this works. The pension fund needs a 7% return to meet their liabilities. In a 1% interest rate environment, companies like Coca-Cola that pay you to own them, and by my definition, that's an investment, they're trading at $55 a share and only have a 3% dividend yield. But if interest rates were, let's say, 5% and normalized, that share price would most likely be around $25 like it was back in 2009. Editor, go ahead and pull up a chart of that really quick. So at that share price, Coca-Cola would be returning a 6.5% dividend yield, very close to what that pension fund needs. But unfortunately, we don't have 5% interest rates, so the pension fund has to look elsewhere. If they can't get paid to own the stock, well, the only thing they can do is buy a stock based on hopes and dreams that it will actually appreciate in value. So they're not being paid to own it. Therefore, by my definition, that's a speculation. Do we really want pension funds speculating with the futures of firefighters, police officers, and teachers? I don't think so. But in this case, Uber is trading at $25 a share, where at 5% interest rates, they would not exist. They themselves would be bye-bye because of this opportunity cost. That's the great point that Jim Grant makes. Uber is unprofitable at any scale. Editor, go ahead and throw up a chart or a graph of how much money they actually lose. It is staggering. In Q2 of 2019, they lost $4.5 billion in that one quarter. So coming back to what Jim Grant is saying, who on earth, especially a pension fund who is holding the hopes and dreams of all of our public servants, why would they invest in a company that's losing $4.5 billion in a quarter? The bottom line is they wouldn't. But you end up holding the bag. You can say, well, shoot, but I like Uber. It's a great service. It's super cheap, which it is. But what you don't realize is that you are paying for that one way or the other. Because when the pension fund goes bust, because Uber is unprofitable at any scale, that means the government is going to come in and raise your taxes. So you, in essence, are subsidizing Uber because you're going to have to bail out that pension fund. And if you think Uber's bad, let's dive into WeWork. WeWork is the same thing. Big concept, work sharing, new age. Let's make it green. Let's make it more. I don't know. Let's make it better. Let's make it more profitable? No, not profitable, loss-making. Still, that's a company that's worth $48 billion. Let us say down from whatever it was. Now it's an $8 billion company. You wonder whether this force of gravity I mentioned might not yet come into play in 2020. So the Fed artificially lowers interest rates. We'll call it ZIRP, 0% interest rate policy. This creates an environment where there is no opportunity cost for investing in a bad business because you can't get a return anywhere else. So the pension funds don't have a choice but to invest in funds like SoftBank, which I love their title. They call it the quote-unquote vision fund. You gotta love that, right? So as an example with WeWork, SoftBank dumped $10 billion into WeWork. That drove its valuation up to $48 billion. But then WeWork tried to go public and they opened up the kimono and the market did not like it at all. Within 3 weeks, the valuation was down to $8 billion. Now SoftBank had to come in and bail them out from going into bankruptcy. So here is one point where I might actually disagree with Jim Grant because I think that gravity has already hit WeWork very hard. And according to Forbes, editor, go ahead and throw up that article, SoftBank has to have WeWork get back up to a $24 billion valuation just to break even. So that means that SoftBank's vision fund will most likely lose the majority of that $10 billion, which if you have money in a pension fund, could possibly be your $10 billion. Step number 3, now we get into the good stuff. How does monetary policy impact the economy? We live to a degree in a hall of mirrors constructed by the central banks. And here, Jim Grant cites Lord Liverpool in an 1818 debate whether they were going to return to gold post-Napoleonic wars or whether they were going to retain a paper-based fiat standard. Said Lord Liverpool, the tendency of any convertible paper currency, in other words, fiat currency, is to produce fictitious wealth, bubbles, the popping of which produce inconvenience. In the video, Jim obviously gets a kick out of that word, smiles, and says, "Ah, that lovely inconvenience." He then says, "You mentioned malinvestment. That's a $3 word. In Brooklyn, we call these white elephants, things that you wish you hadn't bought or built. Lord Liverpool, 200 years ago, called it fictitious wealth." He then goes on to describe very well how the Fed exacerbates the problems we have as human beings when we try to invest. But we, the human species, are an excitable crew. We tend to respond to very low rates with a lot of redundancy, a lot of excess. We do things too much. We can't just own stock at 100 times earnings. You've got to go out and buy some more at 200 times earnings because it's going up. That's the way of the human beast. But the central banks do us no favors when they indulge our human propensities towards overindulgence by sponsoring fictitious interest rates. Nobody says it as well as Jim Grant, that is for sure. Let's start with malinvestment. A very simple example. The Fed lowers interest rates artificially low. This allows or creates companies like Uber. We've got Mike, the millennial here. He's super stoked to be driving for Uber, so he's got himself a Uber hat. He kind of got sideways to look really cool. And he wants to do the Uber Black service and really make a lot of money. So he goes out and buys a $50,000 Escalade. He is going to make a killing as an Uber driver. And we have Bambi, the barista. She's very stylish here, as you can tell by her name. So she's got one of these Pharrell type hats going on here. And she has the opportunity of going out and learning real estate, a profession where she can make maybe a lot of money. But she decides, no, I don't want to do that. I don't want all that stress, and I want the flexibility. And because I can work for Uber or maybe Starbucks whenever I want, this will allow me to pursue my dream of traveling around the country in a Volkswagen van. So she goes out and buys the VW van. She buys a little Prius, and she says, forget learning about real estate because I have Uber. That is an example of malinvestment, because if or when Uber goes under, Mike and Bambi lose everything. They made bad decisions because of the Fed's artificially low interest rates. But it doesn't stop there. These Fed-induced bubbles really bring out the worst in the average Joe investor. This is the anatomy of a bubble, and it really shows this well. It starts off with the media kind of picks it up, and that gets everyone excited. That creates a lot of enthusiasm with people that don't really understand that this is just a complete bubble of excess liquidity in these artificially low rates. Then everyone gets greedy. Then they get even delusional. Now they get to the top of this bubble where they're like, oh my gosh, you got to get in now. This is a complete paradigm shift in our economy. Then they run out of buyers. The prices start to go down, and the average Joe investor then goes into denial. It goes up a little bit, so they say, okay, well, maybe this is just the new normal. But then it crashes, and everyone starts to get really afraid. It goes down even further, and people start to capitulate, which means they have had enough. They never want anything to do with this stock. It's the worst thing I've ever done. And everybody out there, all the average Joe investors, have sold and lost a lot of money. It continues to go down to where there is just complete and utter despair. And I want to point out, this is when the sophisticated investors, the guys with the tinfoil hats, like you and I, the Gunlocks, the Druckenmillers, the Dalios, they come in and start to buy. And this entire process illustrates how the Fed's loose monetary policy impacts the economy negatively by creating malinvestment and fictitious wealth. Step number 4, the Fed misunderstands interest rates. And you may be saying to yourself, well, duh, George, I know that. But trust me, this part is awesome. Let's go right back to the transcript. To set this up, Bill Dudley, who is in charge of the New York Fed, attended Jim Grant's conference where Jim got to ask him a few questions. Bill Dudley said that he had no idea how interest rates would be set except for the Federal Reserve. I thought this was extraordinary. The Federal Reserve actually got down to business in 1914. We had, let us say, a few in history preceding the year 1914. So according to Bill Dudley, there's just no way the market could determine an interest rate. We need the central planners, the intelligent people at the Fed. Well, let's see if that's true. Here's a chart of historic interest rates. It goes from 0% up to 20%. And here's where we are today. Well, Bill Dudley sounds like a smart guy. So you would think that the year that we start with would be around 1913 or 1914 when the Fed was set up. But you would be wrong. Let me go ahead and fill in the date that our chart starts with. 3000 BC. Editor, go ahead and throw up the actual chart. And these are the people that are quote unquote in charge of our economy. You just can't make this stuff up. Jim continues with some incredible insights. My personal complaint is that the Fed and its brethren overseas don't allow markets to adapt. They don't allow prices to be discovered. They insist upon imposing them. I say that as a matter of obvious, objective, factual truth, that markets are better at determining prices than our bureaucrats. Bill says that except for the wise heads at the Federal Reserve, where would interest rates be? Probably they would be not less than 0 as they are in Europe and Japan. Here, Jim brings up something that is absolutely crucial that you understand. And that is the importance of the marketplace discovering prices. As an example of this, let's use Farmer Joe and his piece of land. He wants to sell it because he wants to get a little bit of liquidity, so he puts it out there on the market, but he doesn't really know what type of price, so he just throws out a round number of $1,000. Well, Dennis the dentist, Eddie the entrepreneur, and another farmer, Farmer Frank, all look at that piece of land that's for sale and say, wow, I would really like that piece of land. Dennis says, I'd love to put an office there. Eddie the entrepreneur says, I think I'd put a gas station. And Farmer Frank might like to grow some wheat or corn. So they go into the marketplace to determine how much each of them are willing to pay Farmer Joe for his property. This is the marketplace that's comprised of individuals just like you and I, who understand what their needs and wants are on a daily basis better than anybody. So based on the price that they're willing to pay Dennis for his dentist services, and the price that they're willing to pay Eddie for gas and Farmer Frank for his corn or wheat, that's what determines the price that they are willing to offer Farmer Joe. Well, it turns out that Eddie the entrepreneur is willing to pay the most because that's what the market wants the most. So Farmer Joe takes that $1,000, done deal, sold transaction. Everybody wins as a result. So the question becomes, is this process better? Or would you rather have Bill Dudley with his I love the Fed hat determining the price of that piece of land? That's why we want the marketplace to discover prices and not to have bureaucrats impose prices. Bill also said that the Fed really pays no attention to the stock market. Jim says, I look back to December of last year when the stock market was down 20% and the Fed was almost palpably shaking in its boots. And the Fed just quickly changes. Bill said that the Fed's interest in the stock market is only as that stock market bears on financial conditions overall. Did you get that? If you read between the lines, you see that Dudley is admitting what us tinfoil hatters have known all along. He's saying that the Fed doesn't worry about the stock market unless the stock market brings down the real economy. Well, how would that happen? The last time I checked, the market, quote unquote, is just an aggregation of businesses that are in the real economy. And their performance, meaning the businesses, is based on how much profit they make from the real economy. So shouldn't the share price be based on the real economy and not vice versa? So what he's admitting is that our phony economy is based on asset prices and confidence and debt produced by the Federal Reserve's artificially low interest rates. And proof of this is when Jerome Powell said that interest rate hikes were on quote unquote autopilot. And all of a sudden, like Jim Grant says, the market goes down by 20% and the Fed does a complete reversal and starts to lower rates. So we can see that the line in the sand for the Federal Reserve is a 20% drop in the stock market. But I think that 20% is more than just a line in the sand where the Fed thinks the stock market will actually start to weigh on the real economy. I think there's more to it than that. Why do I say that? Because this 20% means that technically we are in a bear market. And if we go into a bear market, the media is going to pick up on that. The next thing you know, people are going to lose confidence. Not only have asset prices gone down, but then the confidence goes. And if the confidence goes, there's a lot less debt in the system, and all three pillars of our economy implode. That was part one. Stay tuned tomorrow for part two, where Jim talks about the world losing confidence in the dollar and his predictions for interest rates in 2020. For more information on these topics, check out this content right here, and I will see you on the next video.